Hi, welcome back to the channel. In today's episode, I want to talk about something very significant that's happening in the United States right now, because America has just crossed a financial threshold that has never been crossed before anywhere in the world. The total US federal debt pile has now exceeded $40 trillion for the first time in history. But the $40 trillion number by itself isn't actually the most worrying part of this story, because when we start looking underneath that number, there are now several things happening at exactly the same time. The debt pile is continuing to rise, that's obvious. The debt pile is extremely high compared with the size of the US economy. The amount America is spending simply to service that debt has absolutely exploded. Long-term bond yields have moved significantly above 5%, and now the US Treasury has responded by dramatically increasing its purchases of long-term government bonds. So there's a really interesting cycle developing here. More debt, higher borrowing costs, higher interest payments, bigger deficits, more borrowing, and then potentially intervention in the bond market to try to reduce some of those borrowing costs. And the big question is whether the United States is now starting to enter what we would call a bond spiral. Now, before we get into the details today and have a look at the graphs that I've got for you, if you're enjoying these economic updates, can you please give this video a thumbs up? If you could also subscribe to the channel if you haven't done so already, that would be fantastic. And if you've got the option of hitting that hype button, which is the funny little symbol alongside the thumbs up, then please do that as well, because it will really help me with the algorithm, because YouTube gives it a basic boost if you hit that hype button. So let's start with the first graph, because I think this puts the whole situation into perspective. Now, this graph takes us all the way back to 2002, and the orange line here represents total US federal debt. That has just reached $40 trillion. The blue line represents Treasury securities held outside the federal government, which is around $32.3 trillion. So that's basically publicly held debt. And so on top of that public debt, we've got around $7.8 trillion of what's called intragovernmental holdings. But what I think is particularly interesting about this graph is the background, because what we've got here is a breakdown by presidential administration. And underneath each president, we've shown compound annual growth rate of the debt during that period. And what immediately jumps out is that this really isn't a Republican problem or a Democrat problem, it's an American problem. Under George W. Bush, federal debt grew at an average annual compound rate of just over 8%. Under Barack Obama, it was just over 9%. During Donald Trump's first term, it was around 7%. Under Joe Biden, it was just over 8%. And during Donald Trump's current term, it's around 7.5%. Now, obviously, those periods aren't directly comparable. Some presidents were in office for 8 years, some for 4, and Donald Trump's current second term has only been running since January 2025. You've also got completely different economic circumstances. The global financial crisis, which took place in 2007-2008, the pandemic, which was around 2020-2021, wars, stimulus packages, tax changes, different interest rate environments. But the broader message from the graph is clear. Regardless of who's been in the White House, the debt has continued rising, and it's gone up rapidly. Back in 2002, total US debt was only around $6 trillion. Today, we're above $40 trillion. And even more strikingly, when Donald Trump first entered the White House in January 2017, US federal debt was just under $20 trillion. So in less than 10 years, America's debt pile has more than doubled, and the pace isn't slowing down. The US crossed $39 trillion around 5 months ago, and now we're above $40 trillion. So that's roughly another $1 trillion added in less than half a year. But there is another way of looking at this, because whenever we talk about government debt, somebody will quite rightly say, yes, but the economy is much bigger than it used to be. And that's absolutely true. $40 trillion today is not economically equivalent to $40 trillion 20 or 30 years ago, which is why this second graph is so important. This graph shows federal debt relative to the size of the US economy. And again, the trend is pretty dramatic. Back in the late 1990s and early 2000s, the ratio of debt to GDP was around 60%. It actually dropped into the mid-50s, but then everything changed. Following the 2008 financial crisis, debt relative to GDP surged. It moved through 80%, then 90%, then around 100%. Immediately before the pandemic, it was sitting just above 100%. Then COVID arrived. Government spending exploded, economic output temporarily contracted, and the ratio jumped to around 130%. Since then, it has come back down, but if we look at where we are now, it's sitting at around 120%. So the debt pile is currently equivalent to 120% of annual US economic output. And apart from that extraordinary pandemic spike, that's effectively the highest level we've seen across the entire 30 years on this chart. And this is particularly important because the US hasn't returned anywhere close to its pre-pandemic debt position. The emergency may have ended, but the debt hasn't gone away. We've effectively established a new plateau. America went into the global financial crisis with debt around 60% of GDP. It entered the pandemic with it just above 100%, and now it's at 120%. So there's been a structural ratcheting up of government indebtedness. It's basically double what it was before the global financial crisis. But even this doesn't completely capture the problem, because ultimately debt isn't necessarily a crisis if you can afford to service it. And this third graph to me is possibly the most important chart of this entire video. This shows federal debt interest payments on a rolling 12-month basis. And if you just look at the shape of this chart, for years, despite the debt pile increasing, the interest burden remained relatively manageable. During the 1990s, it was somewhere around $300 billion per year. Through much of the 2000s and 2010s, it moved between $300 and $500 billion, even though the actual amount of debt was rising considerably. And there was one very simple reason for that. Interest rates were incredibly low. Following the global financial crisis, America could borrow very cheaply, so the debt pile could increase without producing an equivalent explosion in the interest bill. But then if we look at what's happened around 2022 onwards, the line goes almost vertical. Rolling 12-month federal debt interest payments have now climbed to approximately $1.3 trillion per year. That is an enormous increase. And this is the fundamental issue, because America's debt problem is no longer simply about the amount it owes, it's about the price it's having to pay to carry that debt. And we're now entering a refinancing cycle where increasingly cheap old debt is being replaced by considerably more expensive new debt. The average interest rate currently being paid across marketable Treasury securities is 3.4% for the USA. Now think about that figure, 3.4%. If we compare that with what America is currently having to offer investors, if we have a look at this chart, it shows the recent 10-year Treasury auction, which cleared at around 4.7%. And the market yield has been trading around the mid 4% areas. So the US has an existing debt pile carrying an average cost of 3.4%, but new 10-year money is costing considerably more than that, about 50% more. And this is where refinancing becomes such an important part of the story. The United States doesn't have $40 trillion locked away forever at one fixed interest rate. Treasury bills mature, Treasury notes have different maturity profiles, as do Treasury bonds, and trillions of dollars has to be refinanced every single year. So imagine an old Treasury security that was paying 2% or 3%. When it matures, America has to repay it. But because the US doesn't have tens of trillions of dollars sitting around in an account waiting to pay off these bonds, the only way it can repay the old bond is by issuing a new bond to replace it. But the problem is that that new bond is going to cost 4% or 4.5% or 5% or even more, depending on how long it's issued for. So the principal debt hasn't necessarily changed because of that transaction, but the annual servicing cost has increased significantly. And if we have a look at this chart, it shows the yield on 30-year Treasury notes. And this is where the warnings have become more obvious. The 30-year Treasury yield recently moved above 5.3%. That's the highest level that we've seen since 2007. The latest 30-year auction just recently cleared at around 5.2%. So think about the comparison. Average existing cost of the total debt that the US has is 3.4%. But new 30-year borrowing is coming in above 5%. Now, I'm not saying that the US's entire $40 trillion debt pile is suddenly going to be refinanced at 5%. It won't be, because there's lots and lots of bonds in there that are maturing at different times. But a huge amount of debt is at the short end of the market. And every time cheaper debt rolls off and more expensive debt replaces it, the average cost of the total debt burden rises. And that's why the interest graph has suddenly gone vertical. And the numbers involved are extraordinary. Gross federal debt interest payments over the last 12 months are now $1.3 trillion. That's the amount of money the US has to find just to pay the interest. Separately, the federal government's net interest expense is already running at more than $1 trillion. Debt servicing has become one of the biggest items in the entire US federal budget. And unlike spending on defense, healthcare, infrastructure, or education, you don't get anything back for that investment. It's not actually an investment, it's just a payment. It's simply the cost of money that's already been spent by previous generations. And this is where the spiral starts, because if your debt increases and the interest rate on that debt also increases, your interest bill will go up. If the government doesn't increase taxes or cut spending elsewhere, then that larger interest bill will add to the deficit. A larger deficit, which is the difference between how much you're spending and how much you're earning, means more borrowing. More borrowing means, guess what? More debt. More debt means more interest. And around we go in the spiral. And then something particularly interesting has happened over the past few days. The bond market has started pushing back. Now, I want to be careful with the terminology here. Investors haven't suddenly stopped buying US Treasuries. There isn't some enormous buyer's strike. America can still borrow money. The Treasury market remains one of the deepest and most liquid financial markets in the world. But the market is increasingly saying, yes, we'll give you the money, but we're going to charge you more for doing it. And when the 30-year yield pushed above 5.3%, the US Treasury decided to respond. Treasury Secretary Scott Bessent announced that Treasury is going to double the size of certain long-term bond buyback operations. Previously, the Treasury had planned to buy around $2 billion in each of its operations. That's now being increased to at least $4 billion, so they've doubled the amount that they're going to buy in terms of long-dated money. And these purchases will focus on securities that are in between 10 and 30-year maturity profile. Officially, the Treasury is saying that this is improving liquidity in the market. And these sums are still tiny compared with the Treasury market of $40 trillion. But the timing is really interesting, because this announcement arrived immediately after long-term borrowing costs surged. And the market did respond. Long-term yields have come back down from the 5.3% to the 5.2%. As a result of that, the dollar has weakened, stock market has gone up, gold has rallied, but there is a fundamental problem here. Buying back long-term Treasury securities doesn't remove the underlying financing requirement. If the federal government is running a large budget deficit, it still needs to raise that money somewhere. And therefore, if the Treasury reduces the amount of longer dated debt available in one part of the market, it will ultimately need to increase the amount of shorter dated debt. And that's why traders are now discussing the possibility of greater reliance on Treasury bills and securities further down the yield curve. Maybe it's 5-year money, maybe it's 7-year money, maybe it's 10-year money, because those yields are currently cheaper than borrowing for 30 years. And economically, you can understand the logic. Why lock yourself into paying more than 5% for 30-year money if you can borrow more cheaply for a shorter period? But that does create another risk, refinancing risk, because shorter-term debt becomes due for repayment sooner. If interest rates fall dramatically over the next few years, that strategy might work extremely well. You borrow shorter today, rates go down, you refinance later at a much cheaper rate. But that effectively is a bet on what's going to happen with future borrowing costs. What happens if inflation remains stubborn? And what happens if the Federal Reserve can't reduce rates as aggressively as the markets expect? What happens if the deficit remains enormous? And what happens if investors start demanding an even larger premium for holding long-term US government debt? Suddenly, all of that shorter duration borrowing starts coming back for refinancing. This is why I think the situation has become really interesting. We've now got several different warning signals lining up at exactly the same time. The debt pile has now exceeded $40 trillion. Publicly held debt is above $32 trillion. Debt relative to GDP is above 120%. Rolling annual interest payments have increased to above $1.3 trillion. And new long-term borrowing costs are above 5%. And the Treasury has now increased its intervention in the long end of the bond market. None of this means that the United States is about to go bankrupt. The United States controls the world's dominant reserve currency. It's got an enormous economy and a huge tax base, and demand for Treasury securities remains substantial. But being able to borrow and being able to borrow cheaply are two different things. And I think that is the real message coming from the US bond market. The danger isn't necessarily that investors refuse to lend money to the USA. The danger is that they continue lending America money but demand increasingly higher interest rates to do so. Because when your debt pile is at $40 trillion, even relatively small changes in your average borrowing cost eventually become enormous numbers. A 1 percentage point increase across $40 trillion would represent $400 billion of annual interest every single year. Again, that doesn't happen overnight because the whole debt pile doesn't reprice simultaneously, but it demonstrates the scale of the sensitivity. And the longer interest rates remain elevated, the more of that debt gradually gets refinanced at those higher rates. So I think calling this a bond spiral is becoming increasingly appropriate. More debt creates more interest creates a bigger deficit, the deficit requires more borrowing, and if investors demand higher yields because they're worried about the amount of borrowing, then that makes the interest bill even larger. And the question is how America ultimately breaks this cycle. Will it be higher taxes? Will it be lower spending? Will it be higher economic growth, lower inflation and lower interest rates, or potentially a combination of all of the above? But simply continuing to add debt indefinitely while simultaneously refinancing that debt at increasingly expensive rates isn't a sustainable solution. And that's why this $40 trillion debt milestone is more than about one big number. The charts are now starting to show the consequences for the US economy. So hopefully you found today's video useful, informative, and most importantly, thought-provoking, trying to get you thinking about what the consequences of small actions actually are, how these things build up into a big problem. If you've liked what I've said, or maybe you didn't quite like it, but you thought it was interesting, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. If you've got the option, you see that funny little hype button, and please press that because it will help to boost this video. Thank you so much to everybody for watching this video and also for supporting me. If you've bought me a coffee or sent me YouTube super thanks or signed up as a patron or a member, thank you so much for that support. I really genuinely appreciate it. It's the one thing that keeps me going. Thank you so much for it. Now, unfortunately, I can't show you something to put a smile on your face because of YouTube restrictions, but I had been posting a few jokes recently, so I've got a link to one of them at the end of this video, and if you haven't seen it, then hopefully this will put a smile on your face.